Good afternoon, everyone. Welcome to the afternoon video for TheoTRADE. I am Blake Young. Today is November 22nd, 2023, the day before the Thanksgiving holiday. So volumes are getting a little bit light today, but we are going to be talking about bad durable goods is good. To begin with, let's focus on the durable goods order without taking into consideration core. We know that oil prices have dropped, and that's going to have some impact to purchasing, but what we saw is durable goods order fell negative 5.4. Previously, we had 4.6% increase in purchases. Look at the details a little bit closer, and you can see they went from positive to negative, but that's not uncommon to see go from a month-to-month durable goods order. The question is, how bad is this? And conversely, is it bad enough that it's good? Is it an indication that inflation is over, that we're seeing the destruction of demand? So let's go through a couple of these things and look back historically to see where did we have worse data. And so we're just glancing back, and there's only a few times that we have worse data coming out of durable goods. And the main thing we're doing right here is just so you can visually see where those dates are. So pay attention with me really quickly. We're just going to look at these key data points back through here. And we can see that it obviously happened during the 2020 lockdowns. We had a move in 2017, we had a move in 2014, and had a move in 2012, and one in 2013 that went negative. So it's not just that it went negative, because there's plenty of times it went negative, it's how big negative, and did we see bigger economic slowdowns when we saw these -5 and higher differences month to month. As we go into the data a little bit deeper and look at these previous months, we're going to skip the lockdown and go back to August of 2017. And we also want to look at September of 2014. As we're watching the negative, look at the revisions as well. I'm going to click on the revisions. We never talk about revisions. We don't go back and say, hey, and don't forget that last month it was actually worse than what we thought. If we look at the revisions, we revised lower in these months that went -5, -5. We revised lower and lower. And so if we go back here, we revise lower, we revise lower, we revise lower, we revise lower. In most every single time that we had a -5 or lower, we revised the data lower. We actually saw the numbers come in. Well, let's go over here to this one. And it was actually -6.9. Over here is -1.1. Over here is actually -14%. So they've been revised lower. And we're just seeing that it's bad, but it's actually probably really worse than what we're actually showing in the data. So just keep that in mind. Oftentimes when we have this -5 or lower, we revise lower. So again, let's go back to August 2017. Because I'm using the idea that durable goods is an indication that we're seeing a destruction of demand and maybe some inflation situation going on, I wanted to take a look at what bonds were doing during that same time frame. So if we go back here, and we go back to August 27th. Here's August 2017, and we would have got the report in September. But look right there. Bond prices were holding right through here, and then we saw bond prices go down significantly. That means higher interest rates. Go back to the next time frame, which takes us back. We'll jump back to September 2014. Take a look at September 2014. And September 2014 shows us. Again, we would do September, but realistically, we'd look at the month after October. And we saw a spike, but we really didn't see much movement after that. Let's go back to the previous one to that, which is going to take us all the way back to August 2013. And if we go back to August 2013, which means we look at September, we see the move here, and then down it goes again. So 2 of the 3 so far, and we can keep going back, and you're going to see that a lot of times we're seeing bonds sell off after we see that destruction of demand, which means yields actually go up. Demand for bonds goes down. And so we see an initial drop in those cases. And back to 2013, we had one back here in August or September of 2012 as well. September tends to be a little bit slow. Here's September 2012, so we look at October, and certainly there it goes down and significantly down after that. And so bond prices have had a tendency to sell off dramatically when we have negative data in durable goods orders. We can take a deeper dive if you want to go under the Analyze tab under Economic Data. and you look at productivity and business activity, we're going to look at the manufacturing data. This is going to bring us to the opportunity to look at data in new orders and durable goods. Now, this looks great, right? Up and up and up. It looks like it's a wonderful thing. You can see the pullbacks through here and all the way up. But what we want to do is look at the change from a year ago as a percentage. As we look at the change from a year ago, you can see that we spiked all the way up here, and we're at the 0% level. And so it's not just the trend that we went to -5. This is going into the this last report. And so we're looking at this move, and we're seeing the percentage from year over year, not just the 1 month change, but year over year, we're seeing economic contraction. We've pushed down to the 0% level. The reason why I want to look at this is because we're also going to look at the NBER Business Climate Indicator, which is a recessionary indicator from the Fed as well. If we know that we are going negative, notice where we went negative here. Notice that we went negative in 2019 long before the lockdowns. During the lockdowns, obviously a much more dramatic push lower. If you look at the times we crossed below that 0 year over year, there's your 2016 pullback. You go all the way back through there. We crossed through in August ahead of the recession of 2007, 2008. And we can go back and see that durable goods order as a percentage change from a year ago going negative is a major indicator showing you that we have economic slowdowns. And if we look back through here, most of the times when we're pushing through the negative, we're seeing that followed by a recession. And you see these are the gray areas of the recessions. So here we are pushing through the 0 recession. Here we go pushing through the 0 recession. But we also got a warning early. We were told early because we crossed the negative before and then crossed it again going into the recession. Crossed it negative before crossing the 0 over here. We crossed the 0 before and then went negative. And so as we zoom over here, we don't show the signs of a recession as far as negative GDP 2 quarters in a row. So we don't have that sign yet from GDP. But if we go back to this data here, we're going back to the home page. We can go into the business cycle expansion and contraction. I'm going to look at two different things that indicate recession or warnings of recession at this point. So we're going into this, and you'll see the second one choice here is NBER-based recession indicator. If I click on that, you'll see it goes 1, 0, 1, 0, 1, 0, 1, 0, etc. Well, as we're looking at this, historically speaking, when we've gone up to a 1, we've seen recessionary behavior, and notice that we have not had any of these times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, and 22 times that we have had a recession when we've hit the 1 reading using 3 different probability calculations, 3 different models. If we hit a 1, we've had a recession out of the last 14 times, basically all the times. This last time we hit there and we're showing no signs of recession. At least we didn't have that set up. And that hit in March of 2020. So was that a one-time deal? Was it kind of a one-off and now we don't worry about it? It spiked up and came back down? That's a good question. But if we go back here and go back to the home page and we look at recession probabilities, one of the ones I like to look at is the real-time SAHM, same rule recession indicator. If you look at this, this is what I'm interested in. This is climbing. So there's a huge spike that was probably not very accurate because it was driven by the lockdowns. But looking at all the times we climbed above the 0, every time we got into this area that we're pushing up into the higher values here. This is a 0.25 reading. And we're pushing higher and higher through here. This is the highest level the recession indicator's been at since the last recession, since the previous recession, since the previous recession. Touched it here in the mid-80s since the previous recession. So the value we're pushing to as far as a forward projecting recession, not counting the lockdown, this is the highest level we've been at, and every other predictive indicator has shown that that's a value that has a propensity to indicate, predict, and point to a recession. So going full circle and going all the way back to durable goods orders, the thought process is if durable goods orders are negative and we went from positive 4.6 to negative 5.4 and we see we're crossing that zero line year over year, are we seeing the destruction of demand and is the market reading it wrong? Apparently this negative durable goods order is a positive thing. We saw equities rally today and recover off the lows. And as we're looking at that move, rallying, pushing up higher and higher and higher. We know that Nasdaq has just recently reached its annual high. We've pushed to these levels, and we're seeing the negative durable goods order as not an indication, which normally would be an indication of manufacturing struggling, but as an indication that inflation is under control. But we really haven't seen proof to that, and we know that the Fed is talking very hawkish. So it appears that the market's overreacting and betting on interest rates more than betting on the economy. And if we look at the month to month, you can see last month we hit 4.997%, and this month, again we're still on the monthly charts, this month we've erased much of that. So we went from 5% to 4.42%. Let's drop this down into the daily reaction to see how it behaved with today. And we're really kind of holding the same. So the market is trying to say, don't worry, inflation is over, interest rates are not that big of a concern, but we're really trading flat when it comes to the 10-year Treasury yield. When we look at bond prices, we look at bond prices and say, we're fairly flat there too. So is this simply I'm not afraid rather than a bet or taking risk? If we're not concerned, we don't need to be, if we're not afraid at all, we don't have to be confident, we just have to be not afraid. And if we're not afraid, we are going to start seeing chasing of returns, chasing yields, especially as we go into the end of the year. So these durable goods orders are simply saying that slowdown, I'm not afraid of economic crash right now because that slowdown, even if durable goods orders is a major miss, even if we are going to go into recession, even if we are at the beginning of a recession, we're still in the busiest retail season as we go into Black Friday. As we go into the Cyber Monday, we're still going to see positive news. They're still going to tell us how many billions of dollars were spent over this weekend. And that's going to quell any concerns as far as the economy goes and lets us bet on we don't need to worry about bond prices or bond yields. Let's bet on equities. So take a look quickly with me on equities. Let's go with actually the QQQ. So you can see the QQQ reached a new high today. Pushed all the way up, reached a new high, settled back in to close near the previous day's high. We are creating bearish divergences showing this could be a topping pattern. So we're still betting on and chasing performance, chasing this higher. And there's a good likelihood we're going to try to chase this higher to 400 as we go into the end of the year, trying to finish out the quarter with a solid Santa Claus rally and a solid return for the final fourth quarter of the year. We have not reached a 52-week high, but we're approaching it on the SPY. And we know that we're still betting on performance and chasing performance, partly because when we look at the IWM, we're nowhere near the highs. We're not chasing performance. We're not willing to bet on the small cap. The small cap looks almost exactly like what we're seeing in bond prices. So we're in a holding pattern and not betting on these going higher. So I'm going to expect to see the Russell struggle to move any higher, while performance chasers will try to finish out the year strong with the retail season in full boom right now, even though durable goods failed miserably. Perhaps durable goods will pick up. Maybe instead of getting the newest gadget and watch, phone, computer, maybe instead we're going to see people buying their significant others a dishwasher, maybe a car. Maybe something that's going to be more durable goods based rather than tech based. But for now, we're going to watch performance chasers chase performance into technology, maybe some into the S&P 500, but definitely not in the small caps. And we need to watch for those bonds to break free or to fail. And if they break free, that means lower interest rates, and we can expect this rally to continue at the beginning of the new year. If bond prices roll down and fall, and we see what we saw based off durable goods orders in the previous months, as we showed you before, then that will mean rising interest rates, and we will put a top on this market by the end of the year and certainly into January. Well, thanks for watching. Have a wonderful, happy Thanksgiving. We will look forward to talking to you again next week.